Okay, so if you were watching the markets at all, you could not have missed it. A massive, sudden crash in the price of gold. And almost instantly, a single headline took over to explain exactly why it happened.
I mean, just look at this. Gold prices took their worst single-day hit since late 2025, plunging almost 6%. It was a really brutal, really fast move that, it caught a lot of people completely off guard.
And the story everyone jumped on? President Trump's nominee for the next chair of the Federal Reserve. It's a simple, clean narrative that seems to explain it all, right?
But here's the thing. That simple story, it isn't the whole picture. Not even close. In fact, that headline is really just a distraction from what was actually bubbling up just beneath the market's surface.
So in this explainer, we're going to break it all down. First up, we'll look at that sudden drop. Then we're going to tear apart the headline versus the reality of the situation. After that, we'll get into why this was a correction, not some kind of crisis. And finally, we'll put it all together to understand the huge difference between market noise and market structure.
All right, let's get right into the main event. The story that everybody is telling versus what the market was actually telling us.
This slide pretty much lays out the whole argument. On one side, you have the headline myth that a so-called hawkish new Fed chair, Kevin Warsh, just spooked everybody into thinking higher interest rates are coming. But on the other side, you've got the market reality. This was a totally predictable, almost necessary correction after a gigantic, unsustainable run-up in price.
And here he is. This is the man at the center of the storm, Kevin Warsh. He's a former Federal Reserve governor, and President Trump nominated him to be the next Fed chair. The media immediately slapped the hawk label on him, and the story was off to the races. But this quote, man, it just gets right to the heart of the problem here. It points out a huge contradiction. I mean, think about it. Why on earth would a president who has constantly and very loudly called for lower interest rates go and pick a Fed chair who he believed would do the exact opposite? It just doesn't add up.
And this is exactly why that whole narrative just kind of falls apart when you look closer. First off, Warsh's nomination was not some big surprise. He was one of the frontrunners. Second, like we just said, President Trump wants lower rates, not higher ones. Third, and this is a big one, even the people we call hawks today are incredibly dovish compared to the Fed chairs of the past. And finally, the political and debt reality in the US makes a truly aggressive rate hiking policy almost impossible right now.
So what's really going on is this very common thing that happens in markets. A lot of the time, a big price move happens for technical reasons, and only after it happens do traders and the media scramble to find a news headline to pin it on. The news becomes a convenient excuse, not the actual cause.
So if the Fed chair news wasn't the real driver, what was? What was actually going on under the hood that led to such a massive drop?
The context here is everything. I mean, look at these numbers. In January alone, gold was up 25%. And silver? Silver was up an incredible 60%. Moves like that are just not sustainable. They create a really fragile situation.
It's one of the simplest, most fundamental truths in investing. Nothing, and I mean nothing, goes up in a straight line forever. When an asset gets that hot, that fast, it becomes super vulnerable to a sharp pullback. It's really not a matter of if, but when.
And what we saw has a name. It's called a positioning reset. So what is that? Well, it's a rapid sell-off that's driven by traders all rushing to take their profits at the same time. The key thing to understand is that it's not driven by a change in the fundamental value of gold. It's just market mechanics. Basically, everyone was on the same side of the boat and it tipped over.
So let's list the real culprits here. You had extreme bullish positioning. Pretty much everyone was betting prices would keep going up. You had that insane move in silver, which is a classic sign of late-stage speculation. The US dollar was also getting a bit stronger, which tends to push gold down. And with some shakiness in the stock market, you had this spillover effect where all these crowded trades unwound at the exact same time. It was a perfect technical storm.
I absolutely love this analogy because it perfectly captures what happened. You shouldn't think of this sell-off as a heart attack for the market, but more like a deep exhale. It's actually a healthy process. It washes out all the short-term speculators and it resets the market for its next potential move. It does not mean the long-term trend is over.
This, of course, is the million-dollar question on everyone's mind. After a drop that steep, it's totally natural to wonder if the whole story has changed. Is the party over for gold?
Okay, let's be crystal clear about what this event does not mean. First off, it does not mean the long-term case for gold is dead. Point number 2, it does not mean the asset itself is fundamentally broken. And third, and this is so critical, it definitely does not mean the huge underlying money problems that have been driving gold, like massive government debt, have suddenly just vanished.
And this is a really crucial way to reframe this. Trying to day trade gold based on the latest headline is just a recipe for disaster. Its real job in a long-term portfolio is to act as a form of financial insurance against instability in the whole system. And you don't cancel your car insurance just because you didn't have an accident last month. And the reasons for having that insurance? Well, they are all still firmly in place. We still have record-breaking levels of government debt all around the world. We still have ongoing currency debasement as central banks try to manage all that debt. And we certainly still have major geopolitical and economic uncertainty. None of that changed because of one headline on one day.
And of course, just a quick but very important reminder, this explainer is for educational purposes only. This is not financial advice. Markets are volatile, and it's absolutely critical that everyone manages their own risk responsibly.
All right, let's bring this all home with the single most important lesson from this entire event.
To put it as simply as possible, what we just saw was not some fundamental shock to Fed policy. It wasn't panic, it was the market's own internal gravity taking over, a perfectly normal, even if painful, correction after an absolutely extreme run.
And this is the final thought I really want to leave you with, because it applies to so much more than just one day in the markets. The Fed chair headline, that was noise. Loud, distracting, but in the end, just noise. The parabolic run-up, the crowded trades, the technical setup for a fall, that was the structure. And learning to tell the difference between the noise that grabs all the attention and the structure that actually drives the market, well, that is one of the most important skills you can ever develop as an investor.